So we're going to spend the next 40 minutes discussing moving average convergence and divergence. This trader's secret weapon. And I just told you I'm not going to give you any super secret weapons, but everything we're going to learn about MACD today is public information. Now, I need to mention that there are, if you look on your screen, there are two handouts. You can download these. They are free to everybody in class. You don't have to do anything to get them. Okay, but they're only available in the live class. So I put together for you the MACD indicator handout guide. Just click the download button. It'll be downloaded to your device, and then you can read it, look at it, do whatever you want with it later. And then I've given you the technical analysis guide from investing.com, which is an excellent resource material guide. So keep that. You can look up things. It covers all the fields of technical analysis, all the sectors. It will help answer your questions down the road. So again, there's no enrollment, there's nothing you have to do. Just click the download button, it'll be on your computer. Now in today's class, I'm going to use the term security, but I might say Facebook. In fact, I know I'm going to say Euro. I might say Bitcoin, but I'm not referring to any specific asset. It just gets tiring saying asset, 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 and security, security, security. I also intermix the terms investing and trading. Now we know the difference. Typically an investor takes a much longer term position while a trader takes a short term position. But again, it gets boring saying trading, 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 trading. Now, no matter whether I go to a seminar or give a webinar, stop in a bar. I mean, just today, I was out floating around with my dog because, it's one of the few things we can still do. And I run into some people that I know, and they're talking about the U.S. markets. And what do I think is going to happen? What did I do? What should they sell? What should they buy? I told them I have no idea as much as they have no idea. I said, I've left my retirement, my pensions, my trust funds, all sitting exactly where they are because I figure the markets will come back afterwards. But I have no idea what's going to happen. So, but everybody asks me, what do I think prices will be tomorrow? What do I think they'll be next week or next year? So wouldn't investing be easy if we knew the answers to these seemingly simple questions? But you know what? I don't have a crystal ball and I don't have a Ouija board. So if you're attending this class in the hopes that technical analysis using MACD has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hope that technical analysis using MACD will improve your investing and trading, that I have good news for you. It surely will. Now, MACD was developed by Gerald Arpel in the late 70s. So knowing that, we know automatically off the top of our head, it was developed for the stock market. There wasn't any online trading. There wasn't any Forex trading. There sure wasn't any cryptocurrency trading. There was no such thing as a CFD. And so it was developed for stocks. And it was also developed for markets that moved a lot slower. But it's been adapted and changed by Gerald Arpel over the years. So it is one of the best indicators for online trading, for Forex trading, for fast moving assets. It's used to spot changes in the strength, direction, momentum, and duration of a trend. The MACD is one of the most popular and broadly used indicators for Forex trading. The letters MACD is the abbreviation for Moving Average Convergence and Divergence. The MACD indicator, which requires moving averages as input, falls into the group of lagging indicators. Now, before we get lost here, indicators, and now technical indicators are just one tiny sector of technical analysis. Anything you do on a chart is considered technical analysis. And there are these groups of indicators that are classified as lagging or leading. But that doesn't mean they're good or bad. It's not like the teacher tells you your kid is lagging behind his class, because that is automatically determined to be bad. It's not like telling you the kid is leading the class and it's telling you it's good. In financial markets, leading and lagging are placements. A leading indicator predicts future movement. A lagging indicator confirms that a movement has changed. So you could predict that the trend's going to change, but that doesn't help you that much. But if something tells you the trend has now changed, that helps you. A lagging indicator tells you or confirms that something has happened. The basic function of the MACD indicator is to discover new trends and help identify the end of the current trend. There are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around this trading indicator. Now, before we're going to learn how to trade with MACD and how to use the signals by MACD, we have to learn to understand how to put it on our charts. And I'm going to apologize to you now because this gets a little bit wordy and a little bit boring, and you'll never ever have to do these calculations again. But you need to understand where all these lines come from so that you can understand what the indicator is telling you and when it's giving you good signals or false signals. So let's pop up. I have a chart ready for you. So let's pop up to a live chart. And we're looking at the Euro US dollar 30-minute chart. Not for any trading suggestions. I teach all my classes using the Euro US dollar chart. Now, on the bottom of your chart, you see the MACD indicator. Here, this is where MACD is portrayed on the bottom of your chart. I'm going to make this disappear in a second because we're not ready to just see the MACD. We need to get there. We need to get these lines on a chart. So let's make it go bye-bye. So MACD starts out with the first line or the first calculation, or what we say is the first derivative, starts out using a 9-period moving average. So that's what we have on our chart right now. You see the gold line? That's simply a 9-period moving average based on the close. So what it does is it takes, and we're not going to spend much time on moving averages today, but it takes the close of the last 9 periods, adds them together and divides it by 9 and plots that number on your chart. And that gives you the moving average, and each time fragment, it's calculated again and dropped on your chart and gives you the moving average line. Okay, not a complicated mathematical formula. It's just a simple average. But that doesn't help us that much in our trading, but it gives us a starting point. From this 9 period, now you ask me why 9 periods? Well, 9 or 10 is the standard moving average time frame we use for Forex trading, but this has really not much to do with it. It is what Gerald Arpel tested and evaluated and used in his development of this MACD indicator. It's what works best for CFD and Forex trading in the short-term online market. Maybe if you were trading in the stock market and a slower market, you can adjust the settings, and I'll show you how to do that. You might want to use a longer time frame. For our trading and for the Forex market, Gerald Arpel, the developer of MACD, determined it needs to be a 9-period moving average. Once you adjust this, whether you decide you want to use a 14-period, you then have to test it and back test it and find out if it works and what it actually does for you. So the first line he puts on here is a 9-period moving average. Then he drops on a second indicator, a second moving average, using a 26-period. Okay, that's an odd number. How he came up with these numbers, I do not know. I'm sure he tested and tested and tested and back tested to see which one worked best. But this is only the first step in MACD. Because if we were to trade from these two lines on the chart, we would be trading what's known as a moving average crossover strategy, which is a very well-known strategy, but a very simplistic strategy. But in Gerald Arpel MACD, this is just the first step. Now, what we do is we create what's called the signal line. The signal line is the difference of the 9-period moving average from the 26-period moving average. It's a simple subtraction. So on the bottom of our charts, we start out with a zero line right here. And we would subtract this number. We take this number and subtract that number, and we would then plot the difference above or below the zero line. If the purple line, which is the longer period, was bigger than the gold line, it would be a negative number because you're subtracting a larger number from the smaller number. When they cross over at this point, they're both exactly the same numbers. So what is it when you subtract the identical same number? It's always going to be zero. So we plot this line, which is simply the difference of these two lines above, on the MACD indicator down below. And this is known as the signal line. This line is simply the indication or the subtraction of the longer term from the shorter term. Okay. But whenever this number crosses this zero line, we know that what happened is these two numbers crossed over each other, because when we subtract them from each other, they're zero. Let me make this a little bit darker so you can see it better. Make it a dark blue, and let's make it a little thicker. So this is the moving average convergence and divergence MACD line. Just go to MACD line. But that, again, doesn't tell us anything. It's just it is just the difference between these two numbers above. Okay. So when we subtract this from this and plot it on our graph below, that's where it is. When we plot this to this, we chart on our graph below. Okay. Now, when we, and I'm sorry, we start out with a 12 and a 26. No, a 9, 12, and 26. I'm sorry, we start out with a 12 and 26. Okay, there we go. So this is, at this point, we no longer need these moving averages on our chart because MACD is not placed on our chart. So we are now down below. And again, we have something that doesn't tell us much of anything. So the second step that Gerald Arpel came up with is we take the value of this line over 9 periods, and we calculate a 9-period moving average of this line, of this numeric value. So in other words, if they were crossed over and then the difference was 1, then 2, then 3, then 4, we would add them all together and divide it after we get to 9 periods and divide it by 9 and plot that on another line on this graph paper. This second line is called the signal line. And it is simply a 9-period smoothing line or signal line on the MACD. So we're going to put this on. Let me make it a little bit wider so you can see it better. And so what do we have now? We have the signal line. We call it signal line, or some places call it the trigger line. When the 9-period moving average or the signal line crosses the MACD line, it gives us buy and sell alerts. Let's not use the word signal because it's not telling you to jump in the market and buy or sell now. It's hitting you on the back of the head and it's saying, hey, dummy, here's an opportunity to buy or here's an opportunity to sell. So we can see when these two cross right here, it was giving us an opportunity to sell. When these two cross here, it was telling us there's an opportunity to buy. Again here, and again here. Now, if you notice in all of our conversation up to so far, MACD, we really haven't talked about any specific price. One of the biggest drawbacks of MACD is it doesn't tell you when it gives you a buy or a sell alert, how far that asset's going to go. It'll tell you that asset's about to move up or about to move down. But a lot of times an asset will just fall down a couple pips, won't even cover your spread. So you need to use other pieces of information, because if you just jumped in to buy or to sell, like here, by the time you got in the market here, that asset didn't move anywhere. Okay. Here, it would have given you enough points to get a nice buy, but it doesn't ever tell you how big the move is going to be. So keep that in mind. Now, to take it to the next phase, Gerald Rappel developed what we call the MACD histogram. The MACD histogram is a pictorial value of the difference between these two lines and how deep or how steep the difference is getting. Okay. I only trade from the histogram. Other people use the histogram and the lines. It just depends on what you are most comfortable with. So as we can see on the histogram, what we do is whenever the histogram moves from red to green or green to red, it's at that zero line. That tells you you're getting a crossover or a buy or sell alert, and it would be automatically, you don't have to go back and say which way, which is crossing here. We were in a buy market, it's now flipped over to a sell market. Here, just the reverse. And we know whenever it flips to red to green or green to red, whenever it flips that zero line, we had a crossover. Now, it helps us to visualize the MACD in the depth of the mountain range, if you want to call it that, or the peak in the valley, you want to call it that. If we get a very, very steep peak or valley, we also can calculate that the asset is becoming overbought or oversold. It's also easy to spot divergence when the asset is peaking downward and the price is moving upward. But this is now how we get the MACD. You'll never ever have to do the calculations. You simply go up to your indicators, go to MACD, and it's going to drop MACD on your charts with a 12, 26, and 9. 12 being the first moving average, 26 being the second, 9 period being the smoothing average. You can then, if you want to customize it or adjust it, you can then do as you please. We could shift this over to a 10 period. We can shift it over to a 28. We can shift it down to 9. Okay. You can customize it. And there's lots of people who use a 644. There's people who use a 922.9. Okay. There's gurus out there teaching their trading system using their particular settings. But the fact is, the literature you're going to get, the things you're going to find, the studies on MACD have been with the 12, 26, and 9. Following what a guru tells you that he's come up with, unless he's going to show you years of back testing and verification, it's just a random thing. And you might as well just adjust it yourself and then test it yourself. So keep that in mind. The longer the first moving average, the less signals you get, but it doesn't tell you it's going to work right for this particular market. So you have to get to know its tendencies, and you should never, ever use it on its own. Now, my best explanation to you is an indicator does exactly that. It indicates. They're interpreters of the market. When you can understand what price is telling you on the chart, and you can't understand what your trend and your support and resistance and your chart patterns are telling you, an indicator can help you maybe figure it out, because indicators only indicate. Okay. Indicators also help warn you that something is shifting in the market. So if you're in the market, it may help you understand you want to get out of. Now, a lot of people use a combination of indicators, especially MACD with RSI or MACD with stochastic, to form a trading system. I, on the other hand, don't. But it's not a matter of what I do to what you do, what somebody else does. It's a matter of what you develop and what you know and what you test and what you feel comfortable with. Okay, so let's go back to my PowerPoint now. And so the MACD indicator is typically placed at the bottom of your chart in a separate window, as you saw. And the MACD histogram is an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above its 9-day EMA and negative when the MACD is below its 9-day EMA. If prices are rising, the histogram grows larger as the speed of the price movement accelerates. So when you see that big green mountain forming or the big red valley forming, it's telling you the speed of the markets. And it contracts as the price movement decelerates. And the same principle works in reverse as price is falling. So the MACD indicator is both a momentum oscillator and a price-based oscillator, and is one of the most reliable studies that we have. So as I said, while it's a lagging indicator, it works well in all time frames, and that's very unusual for a lot of indicators. A lot of indicators don't work well at very short time frames. It is highly interpretive. Probability signals is based on the difference existing between the three moving averages and its histogram. While it is slower than momentum indicators such as stochastics and the RSI and CCI, if you are willing to sacrifice a little speed in exchange for safety, it's good at keeping you on the right side of the markets at all times. Now, interpreting MACD. Okay, MACD gives us three different stories. The MACD proves very effective in wide swinging markets. There are three different popular ways that we use moving averages or MACD, and that's for crossovers, overbought and oversold conditions, and divergence, the three that I mentioned to you. Now, crossovers is the basic MACD trading rule, is to sell when the MACD falls below its signal line. Similarly, a buy signal occurs when the MACD rises above the signal line. It is also popular to buy or sell when the MACD goes above or below zero, which you see on the histogram. The histogram is the same as the crossover of the MACD and the MACD signal line. But as I said, the MACD signal does not tell you the depth of the movement. Now, MACD also helps you see overbought and oversold conditions. When the shorter moving average pulls away dramatically from the longer moving average, in other words, the MACD rises, it's likely that the symbol is overextending and will soon return to realistic levels. So you get that when there's a big divergence between the signal line and the MACD line, or when you start to see deep shifts in the mountain and the peaks. An indication that the end of a current trend may occur happens when you get divergence in a symbol. Now, I don't trade from divergence. It seems to be extremely popular. I think it seems to be an extremely popular word because all indicators have divergence. That means with the indicators moving in one direction while price is moving in the other. Okay. You have to learn to study divergence because the same occurrences happen no matter what indicators you're using. Okay. Again, it's not one of my fortes, but a bearish divergence forms when a security records a higher high and the MACD line forms a lower high. The higher high in the security is normal for an uptrend, but the lower high in the MACD shows less upside momentum. So in other words, we see price soaring up while the indicators is showing us a reduction in momentum. It's telling us that something isn't right. Now, remember, I said the MACD is a histogram, is an indicator of an indicator. It is actually all the way down to the histogram. It is a 4-step derivative from price. The first derivative is the 12-period EMA minus the 26-period EMA. The second, or there's the 12 and the 26 put on your chart. The second is the MACD line you put below, which is the difference between the 12 and the 26. The third derivative is the MACD signal line, which is just a 9-period moving average of the MACD line, and the fourth derivative is the histogram. The basis of the indicator is always the asset's price. It takes 4 steps to get to the actual price to the histogram. Now, you want to talk about massaging data? Well, not necessarily a bad thing. Charters should keep in mind that when analyzing the MACD histogram, it is an indicator of an indicator. Therefore, it's designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying security. Now, it has become standard to plot a separate moving average alongside the MACD, which I showed you is the signal line. And it is used to generate, and as I said, not buy and sells. It's to generate buy and sell alerts when one crosses the other, and it creates transaction signals. The signals are very reliable, but again, they do not tell you how much of a move you can expect. So if you were to go back on a chart and put a line across every time they cross over and check it, you'll find that the asset did move either up or down. But you'll find that a lot of times it didn't move enough for you to have a profitable trade. And when it's moving fast and going up and down, below, above and below zero, you can get whipsawed in and out of a whole bunch of trades. So even though it was correct, it didn't give you a profitable trade. So you have to be aware. Okay. And the crossover at the center line is also more important. So you should always be watching the center line, the zero line. Now, like I said, the drawback is you can get involved in several unimpressive gains or even small losses during a rally. The signals were right, but it didn't have enough momentum to give you a viable trade. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change direction quickly. The large number of false signals can result in a trader taking many small losses. So another MACD drawback is inability to take comparisons between different securities. MACD works for a particular asset, but you can't overlay. Some indicators you can kind of overlay and see the similarities between the euro, US dollar, euro pound, euro JPY. You can't, MACD doesn't work well that way. MACD is characteristics fit that particular asset. Now, the MACD indicator is one of the most popular tools in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crossovers of the signal line make it easy for traders to ensure that they are trading in the direction of momentum. Now, I'm going to share with you a short little presentation on how you might combine MACD with other indicators. And then we're going to go back on and talk about some trading strategies.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals such as MACD crosses. Indicator 2, MACD. The Moving Average Convergence Divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter term moving average is above the longer term moving average, this area of the indicator will show activity. When the shorter term moving average is below the longer term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Super Trend Indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the Super Trend Indicator to change red here before taking the short trade. So now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.
So as you can see, you can easily add MACD into a nice little trading scenario just using indicators if you like. Because MACD gives you, very important, it gives you transaction signals, and it tells you the speed and the momentum of an asset. So just like in physics, momentum changes occur before the price of an asset changes. So the strength of the current trend can be measured by channeling the MACD. And it will give you a nice little trade setup. Okay. And these signals help investors increase their profits by trading short or intermediary trends. But remember, like life, trading is rarely black and white. Okay. Applying this new method to the Forex market, which allows effortless scaling up of positions, makes the idea even more intriguing to day traders and position traders alike. So if you want go to www.alvexo.com, go to their education center. They have lots of information on MACD. They have lots of information on building strategies, but you can also use their demo platform to start adding MACD and testing it out and see how it works for you. So thank you very much for joining us today. I hope everybody remains safe and healthy during this global pandemic, and I hope you're somewhere where you can sit it out for a short term, and we'll talk to you again real soon. Hopefully in April, we'll have a whole bunch of webinars because if people are homebound, the best thing is to attend classes and learn. So thank you very much once again. Thank you for supporting Alvexo and investing.com. Bye now.